Question number 3 on depreciation topic. Ram purchased an old car for rupees 1 lakh on 1st April 2012. So the entry will be car account debit to bank on 1st April 2012. So 2012 and 1st April, car account debit to bank 1 lakh. Okay. Charge depreciation at the rate 10% per annum on written down value method. That is, once one example has been done with straight line value, now written down value method. So I will explain it to you as it comes. The car was sold on 1st October 2013 for rupees 60,000. Underline the date and the amount. Prepare car account for year ending 31st March 2013 and 14. Okay. So for the first year, we have to just mark depreciation 2012, so it will be 2013 here, and the date will be 31st March, and your entry will be depreciation account debit to car, so it will be by depreciation. How much? 10% of your 1 lakh into 10%, that is 10,000, and the remaining will be your balance. So by balance, carry it down, that will be 1 lakh minus 10,000 is 90,000. And the total 1 lakh. Now on 1st April of the next year, so 2013, my next financial year, 1st April, balance, get the balance here, to balance brought down 90,000. Now the difference between written down value and straight line method is, you will keep putting depreciation on your original value, which is 10 lakhs here, in your straight line method. But in written down value, the written down value of the asset is 90,000 over here. So every year after placing the or doing the adjustment of depreciation, you get a value which is written down value, WDV. So on that WDV, you make the depreciation, you charge depreciation on that WDV on your written down value method, whereas under your straight line method, you charge depreciation on your original cost. That is the difference. Now they have sold the car on 1st October 2013. So I need to mark an entry on sales 2013, 1st October. How many months actually, that needs to be calculated, but first sell it for 60,000. So the entry for selling will be bank account debit to car. So here by bank, that is 60,000 have been received for sale of car. Now depreciation for how long? April, May, June, July, August, September. 6 months depreciation needs to be charged. So by depreciation, since it is written down value method, charge depreciation on this 90,000 and not on the original value, which is 1 lakh. So the depreciation amount will be 90,000 into 10% into 6 months, that is 6 by 12. So my depreciation comes up to 4,500. Okay, and the balance will be either profit or loss on sale of the car. So my total here comes to 90,000. 90,000, and I have a loss, so since it is a credit side balance, so it has to be a loss. By profit and loss account, loss on sale of machinery, that is your balancing figure, which is 25,500. What I did is I took this 90,000, subtract 60,000 and 4,500 from it to get 25,500. So this is your closing, that is your balancing figure, and this amount will be taken to your profit and loss account as loss on sale of your car.